On this episode, we'll look into current events in the world of state and local tax. We welcome Lance Jacobs, the SALT subject matter specialist here at Washington National Tax Office. From your one stop for tax updates and analysis, I'm Iris.
And I'm Devin.
It's Tuesday, June 10th, and this is Tackling Tax. Welcome, everyone, to the third episode of our video series, Tackling Tax. If you missed the first two episodes, you can take a look at the previous recordings on our website. The first episode, we dove into tariffs, and the second, we focused on the upcoming tax package. Some really great insights there. As a reminder, if you're new here, Tackling Tax is our new show where every other week we will start our episode with a recap of what is going on in the tax world, followed by various segments featuring guests speaking into some of the most important and interesting topics in tax.
Well, with that, let's dive right into our Fast Four stories of the week. In a recent tax court decision in Sorbonne Capital Partners versus Commissioner, the tax court held that limited partners at Sorbonne were subject to self-employment tax on the full amount of their allocable income, not just their guaranteed payments. You see, generally, limited partners do not actively participate in operations of a partnership, and as such, their allocable income is not subject to self-employment tax. However, in the case of Sorbonne, limited partners were actively participating in the firm's operations. And so the tax court applied a functional analysis test where they looked at the limited partners' day-to-day roles, their decision-making authority, and minimal capital contributions to arrive at their conclusion. As for what this means, well, the ruling really reinforces a recent trend of courts effectively saying that when it comes to self-employment tax, they're going to consider function over form.
Well, Devin, that's not the only activity we're seeing, so that brings us to our second story. In what's shaping up to be a showdown over trade policy, the United States Court of International Trade delivered a major ruling on May 28th, blocking the so-called Liberation Day tariffs. The court said the administration oversteps its authority under the International Emergency Economics Powers Act, or IEEPA, as you might have heard it called. The following day, the U.S. Court of Appeals for the Federal Circuit stepped in and effectively hit pause on that ruling by issuing an immediate administrative stay and allowing the tariffs to stay in place while the appeal plays out. In a separate ruling, the U.S. District Court for the Northern District of California dismissed a lawsuit brought by the state of California against the aforementioned Liberation Day tariffs, claiming the court does not have jurisdiction over the case, allowing California to appeal the ruling in the U.S. Ninth Circuit Court of Appeals. Outside of the courts, though, steel and aluminum tariff rates also increased following a June 3rd proclamation from President Trump, rising from 25% to 50%.
The Senate officially returned to session on June 2nd, and it should come as no surprise that the tax bill, which recently passed the House by one vote, will be a priority for them. Now, it's not likely to be a cakewalk, however, as the bill is facing opposition from key Republican senators, including Rand Paul, Ron Johnson, Rick Scott, and Mike Lee, to name a few, all who currently oppose the bill due to the projected debt increase if it were to pass and be signed into law. Now, the national debt is currently sitting at $36.2 trillion, and the Congressional Budget Office recently revised the debt increase from the bill from nearly $4 trillion to down to about $2.4 trillion, which either way, that is a 7 to 12% increase from this bill alone. Other GOP senators remain critical or are undecided due to concerns regarding cuts to Medicaid, as well as the green energy tax credits.
And that brings us to our fourth and final story. Speaking of the bill, one provision that's recently fallen under scrutiny is Section 899, which some have coined the revenge tax, viewing it as retaliatory against inbound foreign investments. So Section 899 comprises of two parts, one of which includes an escalating tax that ranges from 5 all the way up to 20%, and it applies to returns on investment earned in the US by foreign investors who are tax residents of so-called discriminatory foreign countries. This has been deemed as one of the biggest changes to international tax policy in decades, as it could have a significant impact on asset management and foreign investors. If enacted in its current form by the end of September, the increased withholding rates would apply to payments made in 2026. So, all of that being said, only time will tell if the Senate will address these concerns, but it's definitely one to keep an eye out for. On today's segment of the IRS with Iris, we have Lance Jacobs here to talk about what he calls something salty. Yep, he's a man who loves a pun, and also all things state and local tax. He's going to go through 3 items top of his list as most interesting in his field at the moment. But first, let me introduce him. Lance has over 30 years of experience as a state and local tax professional, working with both law and accounting firms. He is a managing director in Forvis Mazars' Washington National Tax Office. He's also a 3 times Masters champion. But Lance, I don't see the green jacket. What's going on there?
No green jacket. I have to admit the 30 years hurts a little bit, Iris.
I mean, 30 years wiser. Am I right?
I guess that's the positive spin.
For sure. Well, welcome to Tackling Tax, Lance. The first topic that I know we talked about going over maybe sounds not so glamorous, but that's Public Law 86272. Before we dive into that, could you kind of take a step back, tell us what that is in general, give us some background?
Sure. And for me, it's kind of an interesting topic, but I could see where it might be a snooze fest for other people, for sure. So the law extends back to the late 50s, early 60s. There was a Supreme Court case that came out that rendered someone who is manufacturing or selling tangible personal property, I believe in Washington state, taxable. And Congress didn't like that. So Congress passed a law. It's codified at 15 USC 381. That's commonly referred to as Public Law 86272, which limits the state's ability to impose an income tax, which is an important distinction, right? Because there are all sorts of taxes that states impose, be they property taxes, be they franchise taxes, be they sales taxes, that are not constrained by Public Law 86272. But Public Law 86272 limits the ability for a state to tax a taxpayer whose only activity in the state is the solicitation of sales of tangible personal property in the state. And I would stress it's limited to tangible personal property. So for firms like ours, for example, that are soliciting sales of services in a state, we're not able to take advantage of that protection. But if you're selling widgets or whatnot, clearly, if your activity is limited to the solicitation of orders in a state, the state's ability to tax you is constrained by Public Law 86272.
And so when you say solicitation of orders, like I'm envisioning someone coming in with, a little sales bill and saying, "Hey, buy my thing." Like, what are we talking about with solicitation of orders?
So, yeah, I think like when I think about the time that this arose, I think about someone going door to door to sell my grandparents a
Right.
vacuum,
Exactly.
right?
Right.
But uh, it can get really esoteric as to what constitutes solicitation and what doesn't. Probably the best example of this is the one seminal Supreme Court case that went to the U.S. Supreme Court on this issue, which involved Wrigley, the gum people in
Mm.
Wisconsin. So they went through a whole host of activities and just going into the state and soliciting, stores to buy Wrigley gum. Yeah, you're okay. But they said if you take back the stale gum and you replace it with new or what they called agency stock checks, that's exceeding the protections of Public Law 86272, and therefore Wrigley was taxable in the state. There's
Mm.
another recent example that came out of Oregon, which was a tobacco case. And tobacco, like alcohol, is highly regulated by the states. So manufacturers can't sell directly to consumers. They have to go through in-state wholesalers.
Gotcha.
And this particular tobacco company sold via two mechanisms in state. One where they went in and solicited the actual retailer, so the customer of the wholesaler, and they left a sheet by which the retailer, the stationery store or the supermarket could place an order, and that was okay. That was mere solicitation. But they also had what they called pre-book orders, and that was basically almost an automatic contract that the wholesaler, they would leave that with the retailer, and the wholesaler really had no choice but to accept that order. And in order for your protections of Public Law 86272 to apply, the order has to be fulfilled from out of state, and the acceptance of the order can't be in the state. And they
Mm,
said, since it was basically automatic that the in-state wholesaler was going to accept the order, they basically said that that was akin to closing the sale in the state, and it exceeded Public Law 86272 protection. But you're right, it can get really, really esoteric as to what is good and what is bad from a
right.
Public Law 86272 perspective.
Interesting. It's all in the details, huh? But
Yes.
it's old. You mentioned it's back in the 50s. I think 1959. So why are we talking about this now? Like what makes this a current event worthy of tackling tax?
Sure. So, um, you know, I don't know if you're aware, in the 90s, the internet happened. So, um,
Imagine that.
um, so basically, what used to be done by the vacuum cleaner salesman knocking door to door to go visit my grandma and grandpa is now being done over the internet, right?
Sure.
And this law, like a lot of state laws, although this is a federal law, hasn't evolved with technology.
Mm,
So there is the Multi-State Tax Commission, which is essentially a coalition of states, um, has and a handful of other states outside of that have enacted certain provisions to address internet sales. So and they've really limited the scope of what's protected over the internet. So
mm,
virtually any cookie activity, I'm not talking about like Cookie Monster cookies. I'm talking
right.
about
You log
cookies that
in,
are
you
under,
say
yeah,
accept cookies. Yep.
correct. Very, very few cookie related activities are protected under the Public Law ID 6272 now, according
Okay.
to the MTC. So I think one of the ones that they reference as being protected is, I don't know if you go online. I went online yesterday to buy new running sneakers, and I went away for a second, and I got an email in my email box saying, "Hey, do you still want these?"
Mm,
Those types of activities are protected, but any other sort of cookie activity is unprotected under Public Law 86272. Basically, any sort of web-based activity that goes beyond a static FAQ on the website, a chat function is too much. So
gotcha.
if I order my running shoes and I reach out to the running shoe company and say, hey, um, I have flat feet. I thought these were supposed to be good for me. They're not good for me. And they respond to me on either via live chat, AI, or anything like that. That's too much, and that's going to cause them to be taxable in the state. So that has come about with this new MTC policy paper that has been followed by a bunch of states, including California, New York, Massachusetts, maybe a handful of others, New Jersey. California adopted this without following its own Administrative Procedures Act. So they
Mm,
they took a temporary setback in court by the American Catalog Mailers Association.
okay.
The court basically said you didn't, they basically threw a penalty flag and said you didn't follow your own rules for promulgating stuff like this. So we're going to invalidate it, but they'll go back and do it the right way, I'm sure, and then it will be ripe again. And then New York, the American Catalog Mailers Association litigated this issue in New York, and actually within the last couple of weeks, they lost the case substantively. They had one minor small win as a result of it, but on the
Mhm.
whole, I think if you're soliciting sales over the internet via New York, you have to consider this now. Although I expect this will go all the way up through the New York appellate process, and it seems likely to end up in the Supreme Court of the United States.
Wow. So lots of activity in the courts, potentially the highest court on this one.
Correct. Yes.
Okay. So, you mentioned that this was brought up not only in the states, but also at the federal level. How can that be if it's a state issue? Like, why are we talking about it in this big, beautiful bill that's in the Congress right now?
So the Commerce Clause of the U.S. Constitution gives um, the Congress the right to regulate commerce between the states. We call that the Interstate Commerce Clause. Um, so if a state passes a law that wholly regulates in-state activity, and
Mm,
that activity doesn't cross state lines. So if they taxed a particular person only doing business in one section of the state, just as an example, I'm not sure that's a practical example, but if it was limited to purely in-state activity, that doesn't implicate the federal Commerce Clause. But once you start crossing state lines, that implicates the Commerce Clause. So Congress in 1960 or 1959, when it passed Public Law 86-272, used its power to regulate the commerce among the states under the Constitution to pass Public Law 86-272. Similarly, now under the House budget bill that just passed, there is a provision in the title that the Judiciary Committee passed that would expand the definition of or would extend protection to solicitation of orders for any activity that occurred in the state that would still be ancillary or related to solicitation, but might also have an independent business purpose. And you remember I was talking about that Wrigley case a few
Right.
minutes ago. This
Right.
would basically overturn that Wrigley case. So anything that
Interesting.
had an independent business purpose, like replacing stale gum, or there was a case that was decided 2 years ago or a year ago in Minnesota where a company had its sales reps doing independent market research and sending it back to the home office. That would now be protected because it would be potentially protected because even though it exceeded the definition of solicitation because it had an independent business purpose, it was still related to solicitation.
Gotcha. Wow. So, we'll see what happens. I mean, do you have any indication about whether that's, a big important thing that might just squeak through, or does the Senate have a huge opinion on it? Do we know yet?
So it seems like, in light of everything else that's going on in the budget bill, it seems like this is a fly under the radar issue. I
Yeah.
think the one potential fly in the ointment, to bring back the fly again, is that it may be a problem from a reconciliation perspective because as I'm given to understand it, everything has to have a direct budgetary effect.
Under the
And
bread rule.
correct.
Right.
And this will have a budgetary effect, but it's a little bit attenuated, right? So if if companies are now paying less state tax, generally speaking, as a result of this new iteration of the rule, we're going to talk about this in a bit, their corporate state and local tax deduction, at least the corporate state and local tax deduction, will go down, which means that
Mhm.
federal revenue should go up. But that may be too attenuated
Got it.
to qualify for the Byrd rule. So we'll see. I think, reading the tea leaves a little bit, I think the Senate might be ready to um, be aggressive with the application of the Byrd rule and the parliamentarian and the CBO based upon what I've seen and heard.
Nice. Well, exciting news. Let's
So,
see what happens. Let's keep along this budget reconciliation strand for a little bit. We heard on the last episode of Tackling Tax, Mark Gerson talk about how the salt cap was really a sticking point to getting the House bill through. I mean, obviously it did eventually, but there was a moment there where there was some debate going on, and we thought it might have gotten through even quicker than it did. So, do you have? Can you talk about a little bit more? I mean, you're the salt guy, right? So, what ended up in the House bill with relation to the salt cap?
two things happened with respect to the salt cap, which was the Salt Caucus, the Mike Lawlers, the Tom Keens, who are Republicans representing districts in high tax states like New York and New Jersey, were adamant that the salt cap be raised.
Mm,
So it was, and I'll just use it with reference. It's a little more complicated than this, but I'll just use as our benchmark the salt cap on people who are married filing jointly. So
mhm.
it was $10,000 under the old regime, and now I think it's going up significantly. I don't forget.
40, I think, right?
Yeah, that sounds about right. Under the new regime, there's a phase out, right? It phases out. It goes back to the 10 if you're modified adjusted gross income, which is essentially adjusted gross income minus a couple of things or plus a couple of things, exceeds $500,000. it's going to drop by 30% of that excess until it hits that bottom floor again.
Okay,
It's
to
also
the 10,000 again. Okay, so
correct,
everyone will get 10,000. Some will married filing jointly could get up to 40.
correct. It also is indexed for inflation, partially indexed for inflation because it grows by 1%. Both the caps and
Mm.
the adjusted gross income cap increase by 1% a year to 2034, and then after that they kind of punt it into the future to adjust for inflation. So
But
that's
it
kind
is
of
permanent.
it is permanent, I
Okay,
believe. Yes.
interesting.
So, and then the second thing is a lot of states um, created a workaround,
Mhm.
which was enabled by an IRS notice that came out in 2020, whereby pass-through entities, so partnerships, LLCs, taxed as partnerships, or S corporations, um, could those owners could basically get an unlimited deduction for state and local taxes, and
Via
that
their ownership, right, of
correct,
the entity.
correct, and it was basically by electing what we call the pass-through entity tax, which was the tax would be basically be imposed on the entity at the entity level and then pass through the owners in such a way that they were entitled to get a deduction. So the House bill um, changed the allowance for that. And it's highly technical, it's exceedingly complex, and the provision I think needs to be cleaned up a little bit.
Hmm.
But essentially, that that kind of workaround will be limited to those businesses that are not in what is defined under the Internal Revenue Code as a specified service trader business. So not those. If you're in a specified service trader business, if more than 75% of your gross income comes from a specified service trader business, you're out. You can't get the benefit.
So
But
Forvis Mazars, for example, right?
yes,
The architecture firms, the accounting firms, the law firms, the doctor's offices, all of those kinds of businesses is what you're talking about.
so I think architecture firms aren't considered a specified service
Oh,
trader
okay.
business under the code.
That's right.
Um, and I had the inverse. So let me correct myself and say if more than 25% of your gross receipts are, so that you're below the 75% threshold,
Got it.
that is from a specified service trader business, then you're kind of out of luck.
Well, we'll see if anything gets tweaked on that. I mean, I read the bill and I couldn't quite understand that piece of it. So thank you for explaining that to us. I did want to shift gears a bit. This is our third sort of topic that you had as our current event go-tos right now for salt, or something salty, if you will. But the third, it sort of serves as an undercurrent for a few things. It's actually the First Amendment. So, yes, the freedom of speech. How in the world does that tie in? I mean, okay, I need to brag on you just for a minute. What was it, a couple of weeks ago, maybe a month ago?
Yeah.
You were sworn in to the Supreme Court bar, which is really
Yes.
cool. And I know you were messaging me kind of during it, but you were able to attend the hearing for the Catholics Charities Supreme Court case. So you were there in person and able to sort of hear what was being said about that. So, how was that experience? Tell us about the case and sort of how that ties into the First Amendment and state and local tax.
Yeah, it was. I mean, it was a fun experience. I had to go the week before to get sworn in, and then I went to the case. A close friend of mine who's a tax practitioner was you have to have a sponsor, so she got up in open court and made a motion to Judge
I
Roberts
love it.
or Justice Roberts, I should say. As a member of the Supreme Court bar, you'd think I'd know that. Um, and then to hear upon her motion, Justice Roberts said upon her motion, and he said my name is admitted. It was a cool experience. But anyways,
I love it.
so I went the next week to hear the actual case, and the case involved Catholic Charities, which is essentially a subsidiary of a diocese in Wisconsin. Its eligibility were to opt out of the unemployment tax regime
Mm,
of the state of Wisconsin. And it really was kind of almost a niche issue because, as we all know, the First Amendment prohibits discrimination on the basis of religion,
sure.
right? So and it also prevents states from meddling too much, because there is some degree of meddling that are allowed to do, but meddling altogether too much in the operation of religion.
Mm.
And so the idea was that this was a charity of the Catholic Church, and that by forcing the Catholic charities to adhere to the unemployment scheme in Wisconsin, it was interfering with the free exercise of religion. And it really spun on some really some minutiae, right? So it came out during the hearing that because of Catholic philosophy, I'll say, the charity itself was not allowed to proselytize. But if it had
Hmm.
been allowed to proselytize, it seemed pretty clear that it would have been entitled to this exemption from the unemployment taxes. So
Interesting.
there was a lot of time spent on and Justice Kagan spent a lot of time saying, so if you were able to proselytize through this, then it would be exempt. Um, but if because you can't, it's not exempt, which seems like an artificial distinction.
Right.
It also there's a principle in the Catholic Church called subsidiarity, which basically meant that this had to operate as a subsidiary rather than be incorporated in the church. The church itself is clearly exempt from the unemployment tax laws. And if the subsidiary, if instead of it being in a subsidiary, if it had been carried out in within the church itself, like it might be in other religions like Judaism or whatever it is, clearly it would be exempt. So it seems like, something that we talk about a lot in tax, a lot of form over substance type of
Right.
issues,
Right.
right?
Sure.
From the flip side, from the state, I thought the state's argument, which didn't seem to go very far, and the justices seemed to not be having it, was this there's a so-called ministerial exemption, which it's outside of the tax context, but allows the labor laws of a state to regulate how a religious organization treats an employee, so long as that employee isn't high enough up in the religious hierarchy. So you can't regulate a minister or a priest or a rabbi, but maybe the administrative assistant that works in that office could be covered by those state laws.
Hmm.
And it seems like the same type of thing here. Reading the tea leaves, this decision will be out before the end of the month because all the opinions of the Supreme Court will be coming out. The next opinion day is this Thursday, so 3 days from now. So we could see it as soon as then. Um,
Wow.
I think everyone's anticipating that Catholic Charities will win, and that will it will trigger off a chain reaction of other effects. I think this charity in particular was it helped developmentally disabled adults. So if
Hmm.
you're a if the First Amendment allows the free exercise of religion, it also can't establish religion. Now, if you're a secular charity that does the same thing, I think there's probably a strong argument that you may be entitled to the same exemption that Catholic Charities is.
So
So,
this can
but
trickle out outside of just, a religious organization. You're saying that this could have implications to nonprofits in general.
correct. Yeah, I think that's fair. And we're seeing more and more of the First Amendment in other contexts too. There's a federal case involving Maryland's digital activity tax,
Hmm.
um, or digital advertising tax, excuse me. They also just passed the digital activity tax, so it's a little confusing.
Okay.
But the digital advertising tax, and it had to do with whether the law itself banned you're allowed to pass it on to the customer, but you're not allowed to separately state it on the bill.
Mm.
And the Comcasts and the other big advertising companies that have a lot of revenue from this type of advertising are saying that violates their First Amendment rights. So
Mm.
we're seeing it there. I was reading this weekend about a Texas film tax credit that, in order to qualify, has to um, portray Texas in a favorable light. Does that impact the
Wow.
First Amendment? That may or may not be, because you could probably argue that Texas has a legitimate state interest in making sure that it will be presented favorably.
Hmm.
But there's also some of the legislation has an added incentive for faith-based
Mm,
films. So that
yeah.
I think that's a little more problematic. So we're seeing more and more of it. It's certainly an interesting thing for practitioners like myself. I'm not necessarily sure it's a good thing from a wider policy perspective.
But the upshot is that state tax and the First Amendment, that's two things that might be said in the same breath coming up, huh?
I think at least in the near term, and practitioners like myself are always looking for new and creative ways to challenge state tax statutes potentially,
Mm,
and this may be a new frontier.
I love it. Well, Lance, thank you so much for your time. I know we really appreciate your discussion and of course your puns. It is so great to have you here and I hope to have you back soon.
Thanks, Iris.
Each episode, we'll bring you what we call a focused foresight of the week. If you found today's discussion interesting, then you'll want to take a look at this one. This week's focused foresight is about Public Law 86-272 and the New York court decision. It builds off our discussion with Lance and drives further into its implications for your business. Now, you can always access our foresights on the WNTO website listed here or at the Forvis Mazars website more broadly.
And that's our show. Thanks for joining. Until next time.